Have you ever stopped to think about what happens to the trillions of dollars that are constantly moving around the world every single day? Well, today, we're going to pull back the curtain on the money market. Think of it as the secret plumbing of the entire financial system. It's this invisible network that, believe it or not, has a huge impact on your bank account, your investments, and the whole economy. All right, let's get into it.
So let me ask you a simple question. Where does your money sleep at night? That cash you have just sitting around, maybe it's in your brokerage account waiting to be invested, or it's money you've saved up for a house. Is it just sitting there doing nothing? Or could it actually be working for you, even just a little bit while it waits? That's really the big idea we're going to unpack.
First off, let's just appreciate the sheer scale of what we're talking about. The money market isn't some building on Wall Street. Nope, it's a massive, global, interconnected system. Honestly, the best way to think about it is like the circulatory system for the entire financial world. It's what keeps the blood, aka the cash, pumping everywhere it needs to go 24/7.
So what is it exactly? At its heart, the definition is actually pretty simple. The money market is just the place where short-term loans are made, and by short-term, we mean anything that matures in less than a year. Now, the two things you absolutely have to remember are, one, it's designed to be incredibly safe, and two, because of that safety, the returns are pretty low. This is not about getting rich, not at all. It's about keeping your money safe.
So who are the players in this massive game? Well, for the most part, this is a wholesale market. It's dominated by the big fish. We're talking about huge banks lending money to each other just to cover their balances overnight. We're talking about the U.S. government issuing short-term debt to pay its bills, and giant corporations who need to manage their cash from one day to the next. The transaction sizes are just staggering. We're talking $5 million on the low end, all the way up to over $1 billion.
Okay, I know what you're probably thinking. This sounds like a club for massive banks and corporations. What in the world does this have to do with me? And that's a fair question. But it turns out it has more to do with you than you might think. So let's connect the dots from Wall Street straight to your wallet. So here's the trick. Financial firms take all those huge wholesale transactions, the corporate IOUs, the government securities, and they bundle them all together. They basically create these investment packages that you and I, the regular investors, can actually buy into. So you get the stability of that giant market, but in a size that fits your budget. And there are a few different ways you can get involved. You can open a specific type of bank account, you can buy shares in a special kind of mutual fund, you can get something called a certificate of deposit, or you can even lend your money directly to Uncle Sam. Each of these tools is a little different, so let's break them down.
All right, now for the practical part. Let's really dig into these options and figure out how they fit into your own financial toolkit. We'll go through each one so you'll know exactly what it is and, more importantly, when you might actually want to use it.
First things first, we have got to clear up the number one point of confusion, a money market account and a money market fund. They sound almost the same, right? But they are completely different animals. One is a bank product, just like a savings account, and it's insured by the government. The other is an investment, a mutual fund, and it is generally not insured. If you remember one thing, remember this distinction. It's crucial.
Okay, let's start with the money market account, or MMA. You can think of this as a savings account on steroids. It's a product you get from a bank. It usually pays a better interest rate than your standard savings account, and your cash is protected by the FDIC up to $250,000. So what's the catch? Well, you might have limits on how many times you can take money out each month, and you might need a bigger initial deposit to open one. And now for its cousin, the Money Market Fund, or MMF. This is not a bank account. It's a type of mutual fund you buy through a brokerage, like Fidelity or Schwab. The fund takes your money, pools it with a bunch of other people's money, and invests it all in those super safe, short-term debts we talked about before. And I'll say it again, there's generally no FDIC insurance here. The magic number for money market funds is $1. That's it. Their whole reason for existing is to keep the price of one share, what's called the net asset value, or NAV, locked in at exactly $1. This is what makes it feel so safe and stable, just like cash. You put $1 in, you expect to be able to take that dollar back out, plus whatever tiny bit of interest it's earned.
But what happens when that fails? Well, there's a name for it, breaking the buck. And it's incredibly rare, but it happened during the 2008 financial crisis. A huge, very popular fund held some debt from Lehman Brothers, you remember them, and when Lehman went bankrupt, the fund's share price actually dropped to 98 cents. It meant that for every dollar people had put in, they were only getting 98 cents back. It sent shockwaves through the system precisely because it's something that's just not supposed to happen. Next up, we've got CDs, certificates of deposit.
These are also a bank product. And the deal is really straightforward. You agree to lock up your money for a specific amount of time. It could be 6 months, a year, 5 years. And in return, the bank gives you a guaranteed interest rate for that entire period. It's safe and predictable, but your money is tied up. If you try to pull it out early, you're going to pay a penalty.
And finally, we have T-bills or treasury bills. This is you literally lending your money directly to the U.S. government for a short time. And because they're backed by the full faith and credit of the United States, T-bills are widely considered to be one of the absolute safest investments on the entire planet. So with all these options, how do you pick the right tool for the job? Well, if you're building an emergency fund, an FDIC-insured money market account is a fantastic choice. If you've just got cash sitting idle in your brokerage account, a money market fund is probably where it's already sitting. Saving for a down payment you'll need in a year, a CD with its fixed rate is really attractive. And if you want ultimate, can't sleep at night safety, nothing beats a T-bill. And all of this brings us to the most fundamental rule of the money market. You've heard it before, there's no such thing as a free lunch in finance. With these tools, you are making a very specific trade. You're giving up the chance for big growth in exchange for peace of mind.
And that distinction becomes crystal clear when you put money markets next to capital markets, the stock market. Money markets are for preserving your money. Capital markets are for growing your money. One is about short-term safety, a place to park your cash. The other is about taking risks for long-term wealth building. They have completely different jobs in your financial life.
So let's just lay out the pros and cons side by side. The good stuff is obvious, right? Your risk of losing money is incredibly low, you can get to your cash easily, and it's often protected by the government. But what's the price you pay for all that safety? Well, the returns are low. So low, in fact, that your money might actually lose purchasing power over time because of inflation. And you've got to watch out for fees, because they can easily eat up what little profit you do make.
Okay, so let's bring this all together. We've talked about this huge global system and the different tools you can use. So what's the bottom line? What does all this really mean for that cash sitting in your account right now? Let me be perfectly clear about this. You are not going to get rich using the money market. That's not what it's for. Its job is to be a safe, convenient parking spot for your cash, a place where it can earn you a little bit of rent while it's waiting to be used for something else. And this is why it really matters on a practical level. If you have a brokerage account, chances are your uninvested cash is already sitting in a money market fund without you even knowing it. It's often called a sweep account. It's also one of the smartest places to keep an emergency fund or to save up for a short-term goal, like a car or a vacation. The whole point is to make all of your money work for you, even your safe money. So I'll just leave you with this one question to think about. Take a look at the cash you have set aside, your safety net. Is it sitting in a checking account earning 0.nothing%? Or could it be in the money market, staying just as safe, just as accessible, but actually working for you, even just a little bit? It's a small shift, but it can make a real difference.